Hi everyone, we've just started the meeting, so we're just going to allow for a few more people to join. So thank you very much for joining us this lunchtime. Obviously, lots of announcements during the budget. Still, I don't think we have all the information just yet, do we?
No. We've got the headlines and some of the details, and probably some of the stuff that's introduced later we'll probably get more over the coming months.
So yeah, our aim is just to have a bit of a discussion, try and sort of debunk the information that we've got so far. Like I say, we've done a few webinars, mainly focused on our clients, but this is open to clients, non-clients, friends. So, but generally, how we run them is pretty open, pretty relaxed. And if there's anyone has any questions or wants to contribute, we're more than happy to get feedback. So we've got the access to the chat for anything you want in the chat. But yeah, I think we'll get going.
Yeah.
So perfect. So I suppose for those of you who don't know a little bit about Gravitate, so sort of our business is our main focus. Now we have our vision statement, which is sort of the numbers that will shape your future. So as accountants, we're sort of passionate really about our clients knowing their numbers. We don't want to be a set of accountants who just turn up once a year and sign off a set of accounts. We really believe in the power of creating that education behind knowing your numbers, creating positive impacts with the encounters we have with our clients, and sort of building a digital firm powered by people. And we have corporate finance, tax, and an accounting arm to our business. So to present today, myself, so I'm Sam. I set up Gravitate 6 years ago.
And my name's Luke. So I joined as tax director back in July, which has flown by.
We're keeping him busy. So yeah, I think mainly I'm just here to I always try and Luke's the technical genius, and I'm the person who just tries to eke out the information to help hopefully make it really relevant to you guys on the call and our clients. So really over to you, Luke.
Yeah. So we've got the current slide showing the main parts that we've pulled out of the budget so far. So we'll be covering income tax bands, NNI bands, student loan minimum wage, inheritance tax, changes on property interest, dividend rates, etc., salary sacrifice, EVs and plug-in hybrids, essentially, exit in your business and changes to employee ownership trusts, tax-efficient investments, a new mansion tax that's been introduced, and sort of just general cash flow and other sort of smaller things that has been buried in the fine print, essentially.
So yeah, plenty to go through, so I might also try and nudge Luke along.
Yeah. So we don't go over. Yep. Okay, so slide number 1, and you've probably heard a lot of this in the news. Essentially, the tax and NI rates that have been in place for probably at least a couple of years and have been due to be froze for maybe 3 years have been extended to 2031. So we've got another sort of 5 years on top of the end of this tax year. So obviously that is officially complying with their manifesto of not increasing tax, but obviously the inflationary increases on everybody's pay over time will increase the tax and NI bills organically. So there'll be a larger proportion of your bill is covered by tax and NI because the personal allowance is not increasing and the basic rate band's not increasing. So the bigger impact is going to be people that's moving up to following bands. So people who are a basic rate taxpayer and who pushed it up into a high rate will obviously feel more pain.
That's just over the
50,000. That's it, yeah. And there are obviously other tax bands. It may be that you're in 100,000, you go above the 100, you start paying at the 60% band, you lose other perks as well. So it's that sort of fiscal drag that can push your pay up, but obviously the rates aren't moving at the same speed, which people will obviously feel. And I think the forecasts are saying it's going to be worth tens of billions essentially over the term. So it's probably the biggest money spinner, but they're spinning it as it's just a freeze. Nothing's going to change, but we all know it will.
So what we're saying there is someone who's on say £40,000, they're going to get an inflation increase each year of 4%. But inflation is obviously, if someone who's on 40 grand got an inflationary increase in line with inflation, that 40 grand plus 4%, let's say, will buy them less
Yeah.
Because everything's gone up by 4%, but except for the tax bands and the tax rates essentially. So that they're going to feel that knock-on effect of the freezing of these bands. Like I say, so it's going to be closing in on 10 years potentially that they'll have been frozen for.
Yeah, quite probably. Yeah. A significant period, and even before that, they've probably not changed a lot. But we've just had a massive freeze for years. From the business aspect, rather than from an individual's, as of the last budget, the employers and I limit was reduced from, I think it was about 9,000 down to 5. Rachel Reeves has announced that 5,000 limit is going to remain again until 2031, rather than being index linked, which it traditionally would be. The employers and I rate in the last budget went up from 13.8% to 15%. So again, that's fixed in this parliament. So again, as employees' wages are increasing, and traditionally the thresholds are increasing, because that's not keeping pace, the employers and I are 15%, and employer pension, which is usually 3%, maybe more, that is essentially an extra charge on top of every pay rise. So you've not just got to factor in the extra £2,000 a year. It's the £2,000 a year plus the employers and I and plus the pension as well. So it's getting more and more expensive on the presumption that probably some or most of you may have already used your employment allowance because of the rates increasing.
Okay, so on that one then, I suppose they did that damage last year, didn't they? Really?
Yeah.
So that I suppose it is a more benefit that the tax free. I know it's not. It's just further.
The rates are baked in.
Yeah.
And the grants are not increasing. So years gone by, the employment allowance grant was increasing over time, and it had a big jump when they brought the last policy in. Obviously now that's not going to change for 5-6 years, whatever it may be. And obviously the inflationary increase on wages, the employment costs are going to balloon, and obviously the reliefs are fixed. So employers are going to feel a squeeze, and they'll be obviously pressured to increase prices.
I mean, if you just look at that chart at the bottom, so that's the salary amount, isn't it?
Yeah. Based purely on minimum wage rates.
So you've got national insurance on top of that, plus pension as well. So the cost to employ an individual full time at 40 hours, so not everyone does it 40 hours, but like you say, you're closing in on £30,000 to employ someone full time, which is a huge change over the last few years for sure.
Yeah. And then when you lump in the NI costs and the pension and everything else, plus other costs of administering the staff, it's just, you can see why more people are put off. And I suppose a final thing to mention then is, so student loans, the threshold's been frozen for student loans until 2030. This is for Plan 2 student loans, which has currently got the highest threshold. But just doing some basic maths on the sort of 21 plus age limit for minimum wage, if that increases by about 4% per annum, by the time we get to the 2030 tax year, the minimum wage will be at or above that level. So essentially, everybody who works full time pretty much will be paying some of the student loan back. Whereas traditionally it was, you'll only repay it if you're earning a good wage. Now it will be, everybody pays it. Some will pay more than others because it's 9% of whatever you earn above the band.
Yeah, I've just put it into a calculator, and so to pay someone £26,508 is looking like 30,500. So it's over the 30k mark. So
yeah, terrifying. So that's that tab covered. The next one we're moving on to is inheritance tax. So one issue that they caused in the last budget that they have actually noticed and fixed was the agricultural property relief and business property relief, whereby if you own a farm or business shares or business assets, there's a £1 million relief per person. But annoyingly, the legislation didn't allow the unused reliefs to be passed over to spouses. All other reliefs could be passed into spouse on first death, but this one wasn't. Unfortunately, they fixed it. So that's not necessarily an improvement, that's fixing an oversight from last year. In terms of actual threshold, again, a very similar picture to the last slide. The allowances and the rates of relief essentially are being fixed until 2031. So the nil rate band, which is currently 325,000, and that has been at that rate, I think, since about 2009. So by the time we get to 2031, that'll be 22 years it's been set at that rate. And depending what rates you use for inflation over that period, you're probably looking at about, that should be up to about 700,000 there. So big sort of big numbers that haven't moved in line with the times. There's then the residence nil rate band that was bought in probably about 5 years ago maybe, which is an additional up to 175,000 per person. That again is fixed, not increasing, and that allowance will be clawed back if an estate is above a certain value, which I think is about 2 million. Again, that limit's not changed, so the inflationary increase on property prices, asset prices, shares, business, savings, investments, etc., more and more people are obviously going to be pulled into the net. And similarly, agricultural property relief and business property relief were reduced to £1 million in the last budget, and that £1 million limit again is fixed until 2031. So even if you have a business now that's worth £1 million and you think you're okay and you're covered, building 5 years worth of inflation, and that may have increased by 30% just for inflation, and if it's growing as well, it might have increased by another 50, 60. So where you could have no IHT issue at the moment, when you're building some sort of 10, 15, 20-year forecast, your estate could be riddled with a huge inheritance tax liability. Again, what was announced in the last budget and hasn't been removed is any people with defined benefit pensions, which are essentially not final salary schemes, if the value of those pensions hasn't been utilised by the deceased person, that will be falling into inheritance tax from 2027. So again, that's going to be another asset essentially on the list for the inheritance tax charge, which is 40% minimum. The statistics I've put at the bottom was, I think, 4.62% of estates in 2023 paid inheritance tax. But obviously, given the rates have been frozen and assets are increasing every year, and the tax takes increasing, the inheritance tax takes increasing by probably 10 to 12% per annum. Given all these changes that are happening in terms of defined benefit pensions, the reduced rate for APR and BPR, and all the clawbacks staying at a certain thresholds, I dread to think what the percentage will be in sort of 5 or 6 years' time. Okay. There's no way to forecast it, but it's going to be it's going to affect a far larger proportion of society than just, you know what I mean, a very small proportion years gone by. So I suppose that's sort of a reminder to sort of look towards more long-term planning. So it may even be that we've got some clients who are looking towards an exit, and it's very much inheritance tax planning is a job for tomorrow. Given the numbers and the rates and the changes that have been brought in, it's kind of forcing people to think about it sooner, because things can be done the earlier we take effect. And I suppose the other thing to mention is there was a lot of rumours before the budget that there was going to be wider changes to inheritance tax, and they weren't brought in. So the potential is that more inheritance tax measures could be brought in later.
Something to look forward to next year.
Yeah, depends which side of the fence you sit on, but yeah.
So I suppose the overarching message on the income tax side is like, look, it is becoming more expensive to employ people, which, although obviously the government have pledged not to increase tax on individuals, the problem is we are going to drive up unemployment.
Yeah, potentially.
So I think the key message on there is you when you're budgeting and forecasting for recruiting, you do need to factor in the full cost of the employment, and I suppose you want to get some certainty on the return on investment, and then obviously from a cost to your business, you know that's going to go up by the 4.1%. So especially if you're a business that's driven by people, you need to be reflecting some kind of increase in your pricing. Is probably the piece of advice there. It's you need to be increasing your pricing to allow for you to retain and pay the same staff, and then going forward, you need to be slightly more savvy with the recruitment process to make sure you're getting return on investment on the people you're bringing in. From inheritance tax, then I suppose a key thing is understanding your position, but is there again a high level number where you say, look, if your net worth or your estate is worth X, then it's worth getting some advice?
Yeah, well, I mean, so the sort of best case scenario, ignoring any reliefs for your business, is currently a married couple could have £1 million of assets and in theory not pay any inheritance tax on that. It will depend on the amount of gifts you've done and other matters. But if you've got a married couple and you've got assets of £1 million or close, I would definitely be reviewing your inheritance tax position. It may be that there are minimal things to do, but essentially the sooner that you review that position, the better. And I think sometimes people don't maybe realise the amount of assets that they've got until they actually start writing it down and realising actually my home's worth far more and the mortgage is minimal or paid off, and the numbers could get significant.
Perfect. Anyone on that one?
No. Okay. So Rachel Reeves announced in the budget that she didn't think it was fair that investment income essentially was taxed at the same rate as earned income. So she has decided in her wisdom that property income, interest income and dividend income will be taxed at higher rates than before. So the changes to dividends are being brought in from 6th of April 2026. The dividend allowance of £500 hasn't been removed yet. There was rumours that it would have been. That's been kept in. So the first £500 of dividends will be taxed at 0%. Beyond that, depending on what tax band you fall into, the rates for basic rate taxpayers will increase from 8.75 to 10.75. High rate limit increases from 33.75 to 35.75. But strangely, the additional rate limit of 39.35 remains unchanged. So there will be maybe not necessarily noticeable, but there'll be a definite increase on your investment income for your traditional SMEs because you've got the mix of salary and dividends. I suppose what it may force you to revisit is, have you got the right balance between salary and dividends? It may be that you did have the right balance 3 years ago and it's not been reviewed, and it's just a reminder to plan for next year, essentially. That may be influenced also by the payroll stuff we mentioned earlier with employers and I. It may have been that maybe you didn't use the allowances before, your workforce has grown, and again, it needs to be reassessed. But yeah, there's definitely going to be an increase for SMEs on the dividend front. For property and interest, so bank interest or interest of any sort, we've got an extra 12 months. So that won't be brought in until the 6th of April 27. Property income at the moment can have a separate allowance of £1,000. Interest income can have a savings allowance of £1,000, 500 or nil, depending on what tax band you fall into. So basic rate taxpayer would get 1,000, higher rate would get 500, and additional rate taxpayer would get nil. The rates of tax in the bands that the interest falls into, or property, will go an extra 2% on all bands. So 20 would go to 22, 40 would go to 42, 45 to 47. So I suppose the point to consider there, probably more with property, is if you've got a large portfolio, is it worth incorporating? There may be significant costs, there may not be, there may be reliefs available, but it's probably another kick to review the efficiency of the structure. It might sort of twin with inheritance tax, whereby it might accelerate your position on gifting properties to reduce your income tax provision and reduce your inheritance tax provision. But again, it's probably not significant enough to influence the decision on its own, but probably part of the wider issue. It's another talking point essentially.
No, I think that all makes sense. Like I say, we spend a lot of time working with our clients on the salary versus dividend planning. I think still around up to the £100,000 mark, you are, and there's a lot to factor in now. Yeah. But how we do a calculation is we will say, okay, what is the cost of the company of paying someone a salary and a dividend? So yeah, it would cost £12,500 to pay the salary, but you get 25% corporation tax saving, and obviously that could be anywhere between 19 and 25%. But so again, that's something else to factor in. But generally speaking, if you can afford to pay a £6,000 dividend, chances are you're making good profits, and you're paying the tax at a higher rate. So yeah, how we tend to look at it is we say, okay, well, the £12,500 actually only costs that, so less than 25% that you save, but then the dividend costs what the dividend costs, because that comes in after tax, and then we would do a comparative to say, okay, what is the equivalent if you put all that through a salary? So I think like I say, the equivalent of a 12.5 grand salary plus, say, 47k in dividends is around a 67k salary. And then so we would say, okay, what is the take home on that combination versus what's the take home on paying yourself 67k salary? We know it costs a company the same, because when you factor in all the taxes, national insurance, and so that's why we're unable to advise our clients. And again, it's case by case because of things like employment allowance that comes. You've got to potentially consider, and the sort of the variable rate of corporation tax. But like I said, we would be fairly comfortable having. We do remuneration planning work with our clients, so we can advise them on that. And then, like you say, the property and interest, it does feel like if you were to today to say, look, I'm going to build a property portfolio over the next X years, but like 5-10 properties, would you be immediately, I know there's other things to factor in, but would you be going down, what would you do?
So best case scenario, I would be planning out exactly what I wanted to do over that period. Because if you know you're going to aim for sort of 5, 10, 15 properties, whatever you're looking for, we could essentially model what that would look like, depending on what you want to extract. Because you could be looking to do that and you have salary or pensions, and that is essentially an investment business. Or it could be that you're doing that because you need to live off the money. And obviously the tax advice on either option would be completely different. The risk that we have is sometimes people buy one property and then buy another and eventually get to 20, but they didn't plan to it.
Stumble into a property portfolio.
And then they find out it's in the worst structure and to move it is really costly. So it's not necessarily always possible, but the sooner you can kind of get advice on that long-term plan, you can often save a lot of money. And I mean, there's no perfect scenario, but we've had quite a few where it's been actually, let's put it in a company, or sometimes they've wanted to put it in a company and it's actually better to be in personal names. Depends on your age, the income, and so many other factors. The general rule of thumb that people read online is it's better for a company. It can be, but do you know what I mean? It's not always, and we've had quite a few recently where it would have cost them probably £250,000 more, plus annual taxes as well to put it in the company. So it's basically, don't just proceed without doing that because the transactional fees to change it later are so significant. And I suppose one other point, back to what you just mentioned, Sam, about salary versus dividends, is regardless of which one's better as well, is there's also a factor to consider of the timing of your tax. So if you're on dividends, the tax on the screen is obviously paid through self-assessment, whereas salary, assuming your tax code's right, your salary is paid as you go. So it might be that dividends may be £500 better per annum, but you'd rather know that your personal cash flow is managed. So sometimes you may opt for the salary option just for clarity. And you've also got the consideration of you've not got to monitor reserves as well, because a salary can be paid regardless of reserves, but dividends can only be paid up to that level. So there's many factors to consider, and we can do the tax angle, obviously, but we can also look into the other angles that might drive your decision as well. We've worked with people who have become overnight successes, and they've just been advised salary dividend is the best way forward, but then they just dread January and July. Like I say, the company has all the money, it's got excess funds, but they've took out so much that they now are of the understanding that, okay, even if they have got this large tax bill to pay, they're going to have to take it out of the business, which is going to add to the tax bill the following year. So, like it can be, the cash flow is one thing to consider, but like I say, just peace of mind is very important to some people as well. So not having to think, oh, I've got to put some money aside for January and July. So it's there's many factors to consider.
No quick answer that I tried to get out of you for the ad structure and portfolio, but well answered.
Okay, next slide then. So salary sacrifice. So salary sacrifice is obviously widely used primarily for pensions, but also for other assets as well, such as company cars. The budget has obviously announced that the limit for NI relief is essentially going to be £2,000 per annum if you're using salary sacrifice. So what that will mean essentially, beg my pardon, and that's from April 2029. So if you currently have that operated, you are okay for another, 3 whole tax years. So milk it while you can, essentially, because after that, it's going to be reduced to £2,000 per annum. on rough calculations, on the basis of a 5% employee contribution, it's around a £40,000 threshold salary. Obviously, that will change depending on if the employee puts in more than the standard, and depends on if you put the pension in based on the whole salary or qualifying earnings. But essentially, if that rate does come in at £40,000, based on the minimum wage discussions we were having on earlier, there's not that much of a premium really between the minimum wage threshold of 30-ish in 4 or 5 years and the 40,000 threshold, where there might be sort of tax implications. So it does appear to have been set at a very low level, and it will affect more people than they'll maybe admit.
Yeah, I think they said it won't affect the average earner, didn't there? Was the comment. But like I say, it feels like more it's set up to include more and more people, for sure.
Yeah, and it's probably a bit politically unwise in some ways when it's widely understood that pensions are underfunded, and this is only going to reduce funding to pensions. Plus the fact of whether state pensions are affordable in future is another matter. It just seems to make a perfect storm to me, but well, we'll see where we go with that one. But essentially the rules as they are is if an employee was contributing more than £2,000 per annum from 29 onwards, they'd get NI relief for the first £2,000 per annum, and then the remainder would be assessed as usual. So essentially there'd be employers' NI of 15% on any balance above, and the employee would pay either 8% or 2% depending on where their earnings fell on that amount. So essentially that could be an extra 20% to HMRC on quite a big amount of money. It's important to mention that regardless of the level of your contributions, the individual will always receive income tax relief. Whether they put in £2,000, 22 grand, whatever the number is, it's just the NI implication that this measure is going to affect. And at the moment, there's been no mention of the salary sacrifice cap widening to anything other than pensions. So the concern was essentially whether it was going to be impacting company cars like electric cars. And it hasn't at the moment. I suppose there is time between now and April 29 where the scheme could be widened, and it may be that that's brought in later. But at the moment, that's not in the news that that's going to be included. Do you have any comments on that one, Sam?
I suppose just like confirming. So, because obviously there's the on a 40k salary, the employee would contribute 5%, and the employer would also make a contribution as well. The cap's not the total amount. Is it just the employee side? Do we know that yet, or?
Yeah, so it's the employee side that will be affected, not the employer.
Okay.
So if there is just an employer contribution, if there was a scheme theoretically where the employer paid X% and the employee paid nothing, then it wouldn't be caught by this. It's only where you've got the salary sacrifice arrangement, which is quite common in terms of you'll say, well, I'll sacrifice 5% of my salary, I believe it is for employees, and then essentially that comes off your gross pay. The employer then pays it across as an employer's pension, but it's at the first instance, it was an employee pension.
That makes sense. And I suppose another thing, and it does obviously, when we act to our clients, our aim is to advise on ways of optimizing the company's tax position. So one thing that we've really been promoting is the benefits of salary sacrifice, because, like you say, especially when the national insurance increase went through, it is a good way for businesses to reduce their national insurance costs. So I suppose the key thing there is it's still there for the next 3 years, uncapped. So any business who probably employs over 7 or 8 people, it really does vary. Because you could have 7 or 8 really high earners, but like I say, if you take 7 or 8 people around the 40k mark, anything over that, then salary sacrifice is still and will be for the next 3 years a really good scheme that will allow employers to save on that national insurance, and it is a win-win because the employee will save as well on how it's calculated. This is talk's not really there to focus on that, but like I say, if anyone wants to know more about that, we can run calculations for you to say, okay, this is your current national insurance bill. If you switch to salary sacrifice, your employees would all be better off. If they earn over 50k, it's marginally better off. If it's less than 50k, it can be a few £100s a year, and then you will get a saving per employee as well. So it's still there for the next 3 years. So again, opportunity to benefit from that whilst it is uncapped.
EVs. So if you've probably bought an EV recently, it's probably not the best news to come in. As probably expected, there was obviously a lot of grants and funding for EVs, and the Chancellor's decided that now's the time to announce the plans to increase taxes. So the electric vehicle excise duty will come into effect from 28, which is essentially 3 pence per mile for EVs, electric cars, and 1.5 pence per mile for plug-in hybrids. From what I've read, it sounds like that will be done based on estimates. So you'll decide that I'm doing 10,000 miles per annum, and you'll kind of pay your what is replacing fuel duty throughout the year. And at the end, if you've underpaid, you'll essentially pay more. There should be consultations on that to tell us a bit more detail. The rate per mile will increase in line with CPI. But I suppose it's always got to be considered alongside what the benefit in kind implications are, because most electric cars or plug-in hybrids will be company cars. So the benefit in kind rate on electric cars at the moment is 3% of list price. That's going to go up to 9% by 29-30. So it will have a large increase. But for plug-in hybrids, the rates currently depends on the electric miles. Could be anything from about 4%, I think, up to about 10%. It's going up to 18 and 19% in the latter 2 years. So plug-in hybrids are going to become really, really expensive. The other bit that I suppose is probably a kicker for plug-in hybrids is they're paying 1.5p per mile for all the miles, regardless of if they're done in electric or petrol mode.
Okay.
So they could do 15,000 miles across the year in 90% electric range, let's say. They're still paying the 1.5p a mile on it, and they'll pay fuel duty on the excess. Or conversely, if it's 90% done on fuel, they'll still pay the same 1.5p a mile charge. So I would imagine that by the end of this parliament, plug-in hybrids will be a thing of the past, because they just won't be economical, I don't think, for company cars. Electric cars will still be probably beneficial, because electric cars don't get hit by benefit in kind on the fuel at the moment. So they'll probably be still quite beneficial. But essentially anybody looking to either move into an electric car or a plug-in hybrid or renewing a lease at some point will probably want to look at what the cost is now and what the cost is over the term of the lease. So if you're locking in for 3 years at the moment, that'll take you up to November 28. So it'll just be the start of the sort of larger increases, let's say. But you definitely want to model how it's going to look over the long term. It may be cheaper on day one, but it may become more and more expensive over the life. And then I suppose the final one on electric cars is, at the moment, companies can claim a first year capital allowance at 100% on the purchase of an EV. So that's not for leasing, it's if they bought one outright. And the same for charge points installed, which may be at the business premises or could be at home. So that was due to expire 31st of March 26 for companies, or 5th of April 26 for unincorporated businesses like partnerships or sole traders, and that's been extended for 12 months. That's been extended quite a few times, so it may be that it's moved again. But essentially, I imagine when the country's got enough infrastructure for electric vehicles, they'll lower the relief on that, and we're quite clearly not there yet.
No, for sure. So obviously significant changes there on the whole. So we're saying the 3p a mile, is it going to be a self declaration then, or how would either me as an individual or Gravitate declare that then?
I think it's on the owner,
and
I think you set it at the start of the year. So if you were to acquire a brand new EV, you essentially decide how many miles you're going to do in the year, and you that's what you're assessed on. And then at the end, that's when you kind of pay any shortfall.
Okay.
I think at the moment it's not worded very well, and it may be that when you sell a vehicle that there could be a shortfall to a new buyer.
Right, okay.
Which I would hope that they've clarified before this comes into legislation, because you wouldn't want to then buy a vehicle and somebody's only paid for 2,000 miles and actually they've done 12.
Wow.
But in theory, it will be a self-assessed thing at the start, and in theory, changes later on. I would imagine the revenue would monitor it, one, on a self-assessment basis, but probably also monitoring the MOT mileage things.
Yeah.
And I've read something that's mentioned that there might be like sort of annual checkups for new cars, probably to check the mileage.
Makes sense.
How much that's brought into guidance and legislation is yet to be defined, but theoretically that's what they've announced at the moment.
Cool, that makes sense. And then I suppose the only other thought I have on that is, like Luke said earlier, the plug-in hybrids, the benefit in kind rate is set on the number of electric miles, and we've because of how the percentages increase, even before really plug-in hybrids, it's only tax efficient to have one if it does a large number of electric miles. But so with these changes, I would expect that most of them will fall out of it. It'll actually be more tax efficient to get the salary and
yeah, I agree.
The car yourself.
I agree. I think a lot of the hybrids as well, because they've got an electric motor and a petrol motor, they're quite expensive because you've essentially got two systems running. So I think there's a new Range Rover that's got the plug-in hybrid, and the list price is probably 130 to 150 roughly. So even if the benefit in kind rate was 10%, it's still a sizable benefit. When it goes up to 18 and 19%, I can't see the numbers actually working out as beneficial.
I've got a couple of questions. I've been very bad on the chat, so sorry about that. So one question from Georgia. It is defined contribution. I think it was just a confirmation that it is the defined contribution pensions falling into the net from 2027, not defined benefit.
Yeah, defined benefit's final salary. If I said the wrong word, that's wrong. It's defined contribution or money purchase.
So thank you, Georgia. So is that a combined 2K figure or employee and employer? So I think we probably clarified employee. That after. So thanks for that, column. And then Joe Elder, could we rework employment contracts so that the pensions are higher, reducing salaries, so it is a sacrifice but dealt with in the contract?
I don't know at the moment. I imagine there'll be anti-avoidance in that. It may be that if you hire a new employee on a brand new contract, you've probably got that option. If you've got a current employee and you look to change the contract, essentially circumventing the salary sacrifice, I imagine there'll be, logically, I would hope that there'd be something brought in for that. But I suppose that is a logical suggestion for hiring employees that are going to breach this 2,000. It may be that you say, right, we'll opt you out, but we'll pay a higher pension contribution to cater for that. But yeah, let's see what the consultations say.
Good work though. Trying to beat the system already. I like it.
Creative. Okay, so probably the biggest one in the budget that we probably weren't expecting, in terms of there were leaks on everything, but not this one, is employee ownership trusts have become quite popular over the past sort of 10 years. As of November 2015, the capital gains tax relief that was in place before has been halved. So previously, a sale of a business to a qualifying business to an EOT would get 100% relief. So the tax on that would be 0 or 0% essentially. Now the relief is only set at 50%. So if the tax rate was 20%, in theory you'd half it and you pay tax at 10%. Based on how the legislation is written at the moment, disposal of your own business to an employee ownership trust, you can't claim business asset disposal relief, which you normally would be claiming if you're making a trade sale, as long as you've not claimed it before. So in this instance, the 50% relief from the top line would essentially apply to the higher rate of capital gains, which currently is 24%, which is why we've quoted an effective rate of CGT for 12% on transactions. Obviously, that will change depending on your annual exemption that you've got for CGT, if you've got any losses, etc. But generally speaking, that's probably a good yardstick to use for shareholders that are looking to potentially use an EOT. There's a potential, obviously, that over time, the 50% relief might change as well, and the higher rate of capital gains tax may change as well. But at the moment, those are the best figures that we have. And it's still better than a trade sale, essentially, when both of the figures are identical. Because at the moment, business asset disposal relief is 14%, and that's going up to 18% after April 26. So both of them are slightly higher than the 12, but obviously it's not as beneficial as it was prior to November, where that tax disappeared essentially. With an employee ownership trust, we normally recommend that it's not considered purely for tax reasons, because not all businesses will suit an EOT, and it's got to be the right business that goes into an EOT. So do it for that reason, not for the tax reasons. But obviously, the revenue are probably thinking that more people have used it than they were hoping or expecting. So it's quite disappointing. But yeah, that was the biggest bomb I think they dropped in the budget.
Yeah, and the fact that it started
immediately
2 days ago, so no one had time to prepare, because obviously there was a big changes to capital gains tax last year. Everyone knew it was coming, so everyone pushed through transactions to get them done in time to benefit from the existing rates. Like I say, that just wasn't the case this year. It wasn't really spoken about. I know Martin was at a conference, so I assume that was for centred around EOTs, because they are so common and popular at the minute. And it does feel like all the things we talk about to owner managed businesses are like of good options have been
clawed back.
Been clawed back. The going after cars, going after EOTs, going after salary sacrifice pension. It's sort of like, look, we're trying to just do best by our clients and show them how they can win, in which is becoming a
very hard environment.
Which is just attacking small businesses. It feels a little bit like, unfortunately. But I suppose when they set the stall out that they're not going to go after individuals, unfortunately, it means the business
community gets
the most impacted. Anything else on that one?
Probably the only thing I'd say on these is if you are looking at doing an EOT, then it would probably be a good time to consider it and review it, and potentially look at the timing of it. So we've got a few clients who were looking at EOTs, but it's very much been, I'll do one in 3 years. Well, that's okay, but if by that time the relief has been wiped out completely, or it's at 75% or 25%, then obviously it's going to get worse. So on some of the discussions we've had, it might accelerate the window that they exit via an EOT, if in that instance it is the best option, because they don't want the risk of either the higher rate tax limit going up, so their 50% relief goes up as well, or that other changes may come into force, maybe a cap or some other metric. So if you're thinking of your exit options, even if you don't know them at the moment, it's a good time to revisit them and consider them. Even if you are thinking that it's going to be 5 years, actually there may be logic to bringing it forward to 3, depending on how the numbers stack up.
No, that makes sense.
Okay, so we've nearly come to the end. So one of the sort of announcements that they announced in the budget was from 2027, under 65s will have a cash ISA limit of £12,000. Over 65s will be able to put the full 20,000 in. That is obviously to inspire people to use stocks and shares, because at the moment not enough people are using them, as other countries, say the US. Whether that will have the desired outcome that the government want, I doubt, but that's what they've decided to bring in. VCTs, or venture capital trust, which we see relatively frequently for high income and high net wealth individuals, which is essentially a portfolio of small companies, essentially in a listed VCT. Investing in those can get income tax relief, which is currently set at 30% of the investment. That's going to be reducing to 20% from April 26. So if you were thinking of doing any, you may want to do them before we get to 6th of April 26 to get that better relief. But practically speaking, with VCTs, depending on who you're investing with, there's sort of timings for the funds, isn't there? So you can't necessarily just invest in one today. If they're full, you may have to wait for a period. So I imagine if you're going to do it, there might be a bit of a mad rush, and the sooner you look, the better, potentially, if that's what you want to do.
Yeah, that's a good point, because like I said, they do open up and they can
fill the funding, can't they?
Yeah, cap out. So that I didn't think about that, and you would expect, again, tax changes make people like accelerate investments and stuff like that. So something like that will mean that the Blackfinches and all the various different things will fill up quicker, you would expect, because of like, it's almost like this the fear, isn't it, of like missing out and stuff like that. So it's probably a case of, if you are planning on doing one, certainly don't leave it till the last minute, because you might be limited on what you can invest in, and therefore, like I say, it won't be as a secure, safe investment.
Yeah.
And with the ISA limit, sorry, so is that so just confirming annual or?
Yes, sorry, yeah. So annual limits at the
Yeah.
moment you've got £20,000 for an adult, which is remaining. But after 2027, it'll be up to £12,000 in cash, the remainder in stocks and shares for under 65, or you could use the full 20 for stocks and shares if you want. Not many people will necessarily fill the ISA, but so the £12,000 limit should probably be enough for most people if they wanted to invest in cash. The VCT point we mentioned then, so the relief's being reduced for the individual. Yeah, there's no change to the amount the individual can contribute into VCTs. The same for EIS scheme, which is essentially investing into a small company rather than a portfolio of small companies, which is what VCTs are. However, the company limits are increasing. So before, a company would have a certain limit for turnover or assets or employees, let's say. Those limits are increasing. So in theory, a wider pool of companies could form part of either a VCT or an EIS. So I suppose from an individual's perspective, they may see it that it's not as risky because it's maybe a slightly later stage company. But because of that, with the VCTs in particular, that's probably why they've dropped the relief. They may think more people will invest, so we have to drop the relief to balance the books essentially. And I suppose the only other one that's not on this slide is, which is in some ways connected, is the EMI scheme. So the EMI scheme is Enterprise Management Incentive. So small SMEs could essentially set that up for senior management and do quite often. The limits for that, again, are being increased so that more people can be part of that, essentially. EMIs are a great option that we see frequently, and if you've got a company whereby you've just missed the limits for the EMI scheme and they've now moved the limits, it might be a good time to jump on board, because if your turnover and your assets keep growing, you may only have a short window to get involved, essentially. The biggest drawback on EMI schemes is often the trade. So sometimes the type of business that the company does might be on the exclusion list. But if you're not on there and you were excluded on size, it's definitely something that I'd be bringing up in conversation. Yeah.
Perfect.
Mansion tax then. So this was heavily rumoured. I don't think it's probably bought in on property values as low as I thought it might be. And essentially, the Exchequer has said that it will affect the top 1% of properties in the UK, and it will apply as a surcharge paid alongside council tax.
Okay.
I think there were rumours that it'd be a levy and you could defer it and other things, and I think at the moment it's meant to be paid alongside council tax. Again, because it's going to be brought in 2028, I'm sure we'll have more consultations and more announcements. But the table below shows at the moment the value of the high value council tax scheme payment, depending on if your property is between 2 million and 2.5 million, you'd pay £2.5 grand. 2.5 million and 3.5 million, you'd pay 3.5. 3.5 million to 5, you'd pay 5 million, and then anything above 5 million, you'd pay a flat rate of 7,500. It may be that those limits change in future. I mean, 2028 will be probably at the end of this parliament, won't it? I can't see it being accelerated because I imagine that there's probably work needed to be done in the background on getting those values updated. And then how they do that. But yeah, essentially, with clients that have got or will may be affected by the mansion tax, that may accelerate their decision on potentially downsizing, or if the properties are big enough, they might be selling off portions of land, outbuildings, etc., to get them below that. I suppose we can react to that more when we see more of the guidelines of what's going to be included within this, essentially.
I think one of the things that stood out to me on this was I think they set out that I think it will raise about 400 million, which doesn't really
no drop in the ocean relatively.
I feel like compared to the issue, and you sort of hear a lot of people, well, the news or certainly LinkedIn, you hear a lot of rumours about people leaving the country, like the billionaires and stuff like that leaving the country. We're actually starting to see it now with clients. So where before it felt like a bit like, oh, that sounds a bit, I don't know how true that is, but we are generally seeing clients move to Portugal and Dubai. So it feels like the risk it's just going to accelerate that movement. And so less taxes being paid by rich people, meaning potential risk for the smaller businesses being hampered further down the line. So it's like I say, given the value it's generating, it feels like did they have to make that move? I'm not sure.
From the rumours that were before, I thought they were going to try and raise at least 1 to 2 billion from it. So I thought that the rates were probably about right, but I expected the top value property to be much lower. But I'm sure there's obviously consideration that values in London, you could have £1 million property and it may not be the stereotypical £1 million property that people think of elsewhere in the country. But then on that basis, when they set the limit so high at 2 million and above, there's only a finite number of properties that are in that range. Plus, I suppose, will that just dampen the values of properties because people won't want to pay it, and then less properties will fall into the band?
You've got to think it's going to have an impact, haven't you? Like, I know, I say the bigger properties, there's only a finite people who are going after them, and like I say, the appetite to invest in one over £2 million just took a hit. Again, what's going to happen if you buy a property for 2 million? If you own it for a year, will it have increased in value and therefore fall under the band? Like, again, it's going to be an interesting one to decipher.
Definitely. Done on that one, Sam? Jump on to the next one. So a few bits in the budget mentioned making tax digital, which has been announced for years and has obviously been delayed. So that's an income tax aspect whereby you've got to do digital submissions personally from April 26. If you turn over on usually rental or self-employment above £50,000, that limit drops to 30,000 from 27 and 20,000 from 2028. Buried within the budget, it mentions that penalties will kick in from 2027. So essentially probably 12 months of a soft landing approach to let everybody understand what they're doing, understand the software, and there'll be payments for late payments and late returns. So late returns, I'd kind of expect. Late payments is probably what I didn't necessarily expect, and may imply that in future they may want you to start paying quarterly or in some regular basis. They have mentioned of a consultation on more timely payments. So they've said that they want to tie in ITSA's income tax self-assessment, which is MTD. That they're essentially trying to say that if you're within making tax digital, they're going to try and collect more of the tax through your pay-as-you-earn income, so salary or pensions. How they do that and whether that's actually physically possible is another matter, because your tax codes can only deduct finite amounts. But essentially that's what they're going to try and do. And if you're outside of income tax self-assessment and you just do an ordinary self-assessment return, they're going to look at other systems, which I assume will be potentially like estimating your tax and doing instalment payments. There's a similar review available or under consultation for pay-as-you-earn and VAT as well to claw back the money sooner and collect more money by direct debit, etc. And HMRC, or Rachel Reeves really, is investing more money into HMRC with debt management. They're essentially wanting to squeeze people sooner and ensure that bad debt doesn't occur. Which I can completely understand, but I suppose it's the nature and the delicacy of why there's non-payment, which might not always be as apparent from just looking at the headline numbers.
I think obviously making tax digital, we've known it's been coming and it's been deferred more than anything year on year. But like I say, if the key thing is if you're a sole trader and you've got
property,
income around that number, then and you're not aware of it, you need to be. You do, because like I say, it's coming in March next year, well, from April next year, sorry. So it's a key one. I've got a storm that's just hit Callum Island or Neeps End, so if it's a bit noisy, sorry about that. Question then, so how do they see themselves valuing a property? What if you buy a house for £1.5 million and do 500k's worth of work? Will you then be taxed, or is it the valuation based on 1991 rates?
Good question, and they've not really announced that, and that is some questions that I've seen on the sort of discussion boards. I assume there must be some sort of new system to maybe value it when you move in, and maybe an annual reassessment perhaps. Exactly how they monitor that and whether that's a self-assessment by the taxpayer is unknown. because practically speaking, then that's just going to potentially lead to people valuing it at 1.999 million. They've not cleared that up, and hopefully that will be clarified over maybe the 2026 year to give people a few years of actual notice of exactly how that's going to impact you. Because I agree, you don't want to be agreeing to do a big refurb on a property such as that without understanding the implications on this mansion tax that's being brought in.
Yeah, it all feels very subjective.
And also, what's to stop them reducing those levels later? Because they had something similar called ATED for companies that was set at 2 million, and it's been gradually brought down to 500,000. Not that I think it'll go that far, but we need to understand the concept so that if they reduce limits in future parliaments, everybody will need to know where they stand on it, essentially.
So Ray's contributed. So thank you, Ray. He's saying that properties are going to be valued and then revalued every 5 years. So
that does mirror what we do with ATED then. Yeah. So yeah, that I suppose that sounds logical and probably avoids a lot of the admin burden, because doing it annually would be a nightmare. Again, on ATED, it is a self-assessment essentially for the taxpayer, but we'd recommend that they get a RIC surveyor essentially to do it. Maybe they'll mirror that for this, but again, if they do that, then for individuals who own properties of this size, you're going to have to get a surveyor out every 5 years, and it's another cost essentially. But yeah, let's wait and see for what they announce on that.
The surveyors will be happy.
Yeah. And then this is the last one, just because somebody asked for this when we did the webinar announcement, mentioned about CIS. So there's no sort of headline changes to construction industry scheme, but within the budget, there's been a lot of mention of HMRC seeking to crack down on fraud, essentially, within the supply chain. There's an option called growth status where a contractor can ask to have no tax deducted from the payments it receives. It applies for that, and if it gets granted, then it's got better cash flow because it doesn't have to have 20% deducted throughout the year and apply for it back at year end. And also, it's probably there's a perception from the payer that the subcontractor is a much bigger company because they're registered without deduction. If there is any fraud detected, gross payment status can be refused for 5 years at least, and then you have to reapply. So that can have a massive impact on cash flow if that is an impact that's felt by your business after 2026. And mirroring some legislation we have for VAT, which I think was the Kittle case, HMRC will be looking at businesses, and where there's a fraud in the supply chain and there's tax that hasn't been paid, they will kind of look at if businesses have done sufficient due diligence, which will be based on the size of the business as well. So there won't be the same due diligence expectation for 2 people running a business as 102. But essentially, if a person or a business knew or should have known that there was fraudulent or evasion of tax, they can look to assess it on that business. There'll be then 30% penalties, and under the VAT regime, which I understand it will mirror for CIS, there's a potential then to chase the directors personally as essentially like a personal guarantee. That can obviously be quite a big thing. So I suppose for anybody working within CIS, it would lead me to want to do more due diligence on the people we're engaging within the chain, checking status of subcontractors and ensuring everything's all above board. And I suppose that the final question or final mention it leads on to there is within CIS or within construction and the sort of wider economy, sometimes umbrella companies used to employ staff, whether that may be a recruitment firm or just a direct employer. From April 2026, HMRC are bringing in powers to pursue the agency that have employed the umbrella company or the client who's employed the recruitment agent who's employed the umbrella company if pay-as-you-earn has been incorrectly paid. So what would often happen in some umbrella companies is they pay the minimum wage in a loan, let's say, essentially a tax avoidance scheme, and the umbrella company may go bust. The revenue now will have powers to essentially reassess that liability elsewhere, so there's less fraud within the system. So if you are in construction or you are using umbrella companies, checking the status of the staff, whether they're self-employed or employed, and whether you use umbrella companies would be sort of high on the list.
Perfect.
I think that's it. Any questions?
We've obviously gone
perfect.
through, somehow. That doesn't normally happen. But yeah, any questions? We're happy to hang around for a little bit. We do put a lot of we share a lot of information on LinkedIn, so I'll just put both of our channels on there. If you, like I say, especially Luke, he tends to share more useful stuff. To be fair, he's very on it with the tax changes and stuff like that. Any feedback? We're always happy to receive feedback. If you enjoyed it, if it was good, if it was beneficial, let us know. But like I say, thank you for giving up your lunch and joining us. If you have any questions, you can email us, contact us on LinkedIn. Our information is the LinkedIn contacts there, and obviously more information on our website. But yeah, we'll hang around for a couple more minutes. But if not, thank you for joining us and for the questions.
Thank you.